So I'm going to show you online an example of that. This is the site in action. We're actually on the internet at the moment. And the first part you'll see on the property calculator is the taxable income. Now, one of the biggest problems you have when you go to look at your next property is the fact that you have to put an income in. You have to be able to know what the starting base is. But the problem is that most people can just tell you what they earn from their job. And once you've got tax deductions, that changes. And those things can change quite significantly. So basically, if you look here, with one click of a mouse, it takes into account all my income and my spouse's income, the ownership levels of our properties, all the depreciation that we have, and works out what our current taxable income is on our property and puts it into that place. Now, I don't know whether you remember from the previous page, but these people's normal income was $85,000 and $35,000 or $32,000. And you can see that that's different now. Because all the deductions and all the income and rent that have been considered, the taxable income is now different. Now that would make a significant difference to the numbers that are going to be spat out when you put the property financials in, which we're going to do now. So one of the important things is also being able to choose the ownership. Now you can see here that we've got, it comes up as a 50-50 and we've got Fred and Marion, but we also have another share. Now it doesn't happen very often and Destiny clients will know that we often advise against including other share people because it can be fraught with danger. But if you are going to do it, you need to know how those numbers are going to work out. So you're able to do that, but I'll leave that as it is for now. What we do is we have an identifier which just allows you to be able to save the numbers that you do so that you can compare them against other calculations you may want to do. We'll put in some yearly costs. We'll say there's $2,100 in yearly costs. We'll say that they've got a rent of $250 a week. Depreciation of, we've got BMT to do it, so that we've got a good depreciation of $4,500. The purchase price, we'll say $210. I'm just picking these numbers out of my head. Purchase costs, we'll say $10,000. The cash deposit, I'll just say $5,000 just to use the... And borrowing costs, we'll say $1,200 because obviously you get a deduction on your borrowing costs, so that's very important. And we'll put an interest rate of 7.2%. So they're just the numbers as they appear when you're first looking at the property, okay? So we'll go through the next page and we'll go up the screen. Now you'll see on here, we've got all those numbers that we just put in on the left-hand side. You'll see the purchase price, yearly costs, weekly rent. But when you're looking at a property, there's risk factors that you have to factor in. Things like different interest rates, whether there's going to be vacancy, you can see down the bottom. But also negotiation factors, because you might want to say, okay, well, what happens if I got it for $5,000 less? And the yearly costs were only $2,000. That can make a huge difference. Or you're going to an auction and you want to work out what's the limit that I can go to as far as paying for this property. So let's just say we'll make a change to it. We'll say that you're a good negotiator and you can get it for $5,000 less. You're a Scotsman, so you can cut the costs back. And you're hard, so you'll make your people who are staying there pay $10 a week more rent. And BMT have said, no, look, we can probably do better than that, so we're going to put a bit more depreciation. Keep going. Okay, so we'll say an extra $500, but we'll say because we're also a little bit cautious and we know the interest rates are going to go up in the next little while, we'll add some. We'll put the interest rates up, which is a risk factor, and we'll say that this place has 3 weeks vacancy. Okay, and you can change the ownership structures if you want to play around with those. You may want to try and work out which name it's better to put it in, different things like that. So there's a few positive and negative factors in there. Now down here you'll see that what we have is we have the results. We have our base results, and those results are going to work off our current financials. We'll take all that into account, but it'll just work on the property figures that we had at the beginning. Okay, so the base ones that we had. Underneath in the comparison are the ones that we've changed them to. So with the new interest rates, the vacancy factors and all those things. So what it does is it gives you the base results at the top. So it'll give you the pre-cash and weekly cash flows, the after-tax yearly and weekly cash flows, the pre-tax yield, the after-tax yield, importantly, the personal cash flow, the portfolio cash flow, so the new portfolio cash flow, okay? Because if you bought this as your first property, it'd be different than if you bought it as your second, third, 10th, 15th property. It's different. And also what your new LVR is going to be, okay? Because you want to know whether now you're going to, because obviously when you buy a property, you're using up equity, you're paying, you know, there's costs involved in that. So the $210,000 property may end up being, you know, 215 financed or 220 financed. So all those things have been taken into account. And then underneath you can see that you have the comparison, which tells you, based on those numbers that we put in, and you can just change one line or you can change them all. And it gives you the difference between the two. But all very quickly. You didn't have to go through and work out what your current taxable income was and then go through all that type of thing. You saw how quickly I did that. But that considered everything that you've in your financial life, all your income, all your expenses, all your deductions, all your everything, even your personal. So your, you know, what you spend on your weekly groceries, if you want, you can get all that stuff and it can be put into the system so that you know that when you buy this next property, although it may be, you know, only slightly negative, that it's not going to make you then have to sell in 6 months because you can't afford to keep it. So, as you can see, it's limitless what you can do with that. And then, if we save it, we can actually save that back to our list where it has all those, so we can compare them. So you might say, okay, well, I'm going to look at one property, but I'm going to do a lot of different scenarios. I'm going to do one with a scenario of interest at this, or whatever the case may be. Or you may utilise this to do calculations on 20 properties and then look at how they compare with the different important numbers. But remember, it's always utilising exactly what your financials are, not the person next door, not an average, but you. And that's always very different.